Hey everyone, I'm Jeb Smith, real estate broker here in Southern California, and today we are going to dive into the housing market in more detail. We're going to talk about housing market predictions for 2021. I'm going to tell you why I don't believe a foreclosure crisis, this huge foreclosure wave, is going to come next year, and I'm going to back it up with some data. I'm going to show you a couple of different graphs with regards to homeowner equity, what's happening when people are actually coming out of forbearance. Are they able to make their payments? Are they missing payments? Are they becoming delinquent? So we're going to take a look at that, and we're going to talk a little bit about the difference between this year and 2008. Now, I did a video in the past where I discussed the '08 versus the 2020 housing market and how they differ, but I get a lot of people keep going back to 2008 and referencing, all the foreclosures that came to the market at that time. So we're going to talk a little bit about that. If you want to watch that video, though, I'll link to it here. But this video is going to be talking more about what we're expecting over the next couple of months. Taking a look at these graphs and really diving into why this is different than the last time we went through this. Now, this isn't, my video to tell you to buy a house. That's not what it's about. I'm here to guide you, to provide education, to help you understand the data that's out there, because if you're watching a lot of the news, or honestly a lot of people on YouTube, you're seeing a lot of doom and gloom out there. And so I just want to tell you what I'm seeing based on the data, somebody that's been doing this nearly 18 years with boots on the ground, and how my view differs from everybody else's view out there. So what we're going to do first is we're going to bring up a chart that is going to show you what's happening when people are exiting forbearance. And the reason I bring this up is because forbearance seems to be one of the big pieces to the puzzle that everyone thinks once forbearance ends, you're going to see this huge foreclosure crisis. And based on the chart that I'm going to bring up, I'm going to tell you why I don't believe that. But just so you know, these charts came from Keeping Matters Current, which is a website out there. I'll link to it in the description below to give them credit where credit's due. And the data came from Black Knight. So Black Knight monitors mortgage data, and probably the best source for it out there. And these reports, this report is from September. So this data is a couple of months old, but it's because it takes a while to compute this data to put it out there. So in complete transparency, this is a little bit old, but I'll continue to do these as information comes out, so you have up-to-date information. So let's take a look at and pull up this first graph here. So the first graph is showing what happens when 5,760,000 families were in forbearance and actually came out of forbearance. So you see a large majority, over half of those people, 2.3, almost 2.4 million people actually extended their forbearance. So if you're familiar with the forbearance process, and the CARES Act, you have up to 1 year of forbearance. So regardless of when you entered it, you have 1 year. So you could have entered it last month. You have until next November, if you will, to stay in forbearance. So you're going to have people continuing to extend that, and there's a lot of people out there that need it because of loss of employment or what have you. But also understand there's a lot of people in forbearance that don't need forbearance. I'm constantly having people reach out to me either by phone, email, and even commenting on these videos telling me, hey, look, I'm in forbearance, I don't really need it, I'm just using it to save money so I can buy a house or do something other, pay off credit cards or what have you. So yes, there's a lot of people in forbearance, but the reality is we don't know how many people actually need it, but a large majority of people are extending that forbearance. But nearly 44% of people who have exited forbearance have either continued to make their payments on time, which is part of that 2,302,000 that you see right there. They were removed from forbearance and continued to make their payments on time, so they're on-time payments. And then you had nearly 500,000 people pay their mortgage off. So they either sold their home or refinanced their loan somehow, but their mortgage got paid off and they're no longer in forbearance. So that equates to about 44% of the people that were in forbearance have exited and continue to pay on time. Now, the 481,000 that you see here, expired, delinquent, and loss mitigation. What does that mean? That means their forbearance expired, so they reached the end of it. They didn't choose to extend it, but they went into some sort of loss mitigation, which means they're either trying to modify their loan, restructure their loan, or what have you, but that they're not currently delinquent with their bank. So they're trying to figure out exactly what's going on with the mortgage, but not really necessarily behind on their payments at this time. It's just something that they're trying to work out. And then you have 80,000 people that are actually delinquent on their mortgage. So they exited forbearance, their payments became due, they just didn't pay them. So a very small percentage, I realize 80,000 is a lot, but if you take that nationwide, spread it over 50 states or what have you, it's a lot less people than you think it is. So, and keep in mind, not all of that's going to come to the market at the same time if those did result in foreclosure. So that's one of the graphs here. I'm also going to pull up another one, so give me 1 second here. So this is a different graph. So this graph shows the distribution of loans in active forbearance by current loan to value. What does that mean? So when you're in forbearance, you know, they look at how much you owe versus the appraised value of your home. That's loan to value, what you owe versus what the home is worth. So 62% of the people in forbearance have at least 30% equity in their homes. So that means if your home's worth $100,000, that means that their mortgage is worth, you know, is $70,000 or less. So they have $30,000 in equity in that property. Take $1 million, for example. $1 million property, they have less than $700,000. They owe less than $700,000 on that property. So they have a good majority of equity in that property. Over 2/3 or 1/3 of that property is in equity, which means that if they did come out of forbearance and they needed to sell their property, they can and probably walk away with money in this case. They wouldn't have to foreclose. They wouldn't have to short sell. There's equity in the property. And then if you look at, I could do this with each one of them, but you know, there's, I think, 91% of people have at least 11% equity in their property. So the large majority of people that are in forbearance have some equity in their property. They're not upside down on their property like 2008. In 2008, as we've discussed and before, was a different time. People were upside down on their mortgage. They owed more than the home was worth. There was way more supply on the market at that time. Buyer demand wasn't nearly where it is right now. And a lot of the loans at that time were what they called liar loans. They were people that they weren't verifying their income, weren't verifying their assets. You know, some of them were negative amortization loans. There was just a lot of stuff that, you know, didn't require verification back then, and a lot of people got loans they shouldn't have gotten, and they ended up missing payments, owed more than the house was worth. There wasn't, you know, there was forbearance back then, but they're not the programs that they have right now, where everyone that essentially needed it was granted it because of the CARES Act. So a different market. 91% of people had equity in their property at that time. Or at this time, that's a lot of people that have some sort of equity. Now, if you miss payments for a year, clearly some of that equity is going to go away. There will be some short sales. There will be foreclosures as a result of this, but not to the extent that I think a lot of people think there is, just because of how much equity is in people's property. And then the last graph I'm actually going to show you is let's see here, is going to show us home equity cashed out. So right now we know a lot of people are refinancing, taking advantage of low interest rates, and that's one of the reasons that you are seeing a low supply of homes. Right now the market that we are currently in is being driven by low supply, high buyer demand, which is being fueled by low interest rates. But a lot of people are refinancing now into rates, you know, we may not ever see again. And so a lot of people aren't going to sell their property. They're getting their payments so low that those properties are no longer probably going to come on, or no longer going to come on the market for some time. These people are going to live in these properties for quite some time, because it's going to be hard to get rates this low again. But you know, a lot of the rumors out there, and a lot of people are talking about, well, everybody's cashing equity out of their houses. It's just like it was in 2008, where everybody's doing these cash out refinancing, pulling out 100% of the equity of their property. And you know, this is the same thing that happened in 2008. It's not. Lenders aren't allowing people to cash out nearly the amount of cash that they did back in 2008. You know, you have to have you know, a lower loan to value these days. So there's a lot less cash coming out of the property. But you can see in this graph here, 2005 through 2007, I mean, it was triple the amount of home equity cashed out as today, maybe quadruple in some cases. So a lot less equity coming out of property these days than there were back then. Now, you know, as I've mentioned in several videos leading up to this, is that you are going to have effects of what's going on right now, right? There's likely going to be additional stimulus coming to the market. It's going to help ease some of the pain, but there's a lot of renters out there that aren't making their payments. Some are taking advantage of the system. Some truly need it. We don't know what the numbers are on either side of that. We're going to have landlords that are definitely affected by all of this. So there's going to be a lot of people affected. I'm not denying that. But what I'm looking at is the supply and demand imbalance, right? There's way more demand right now, buyer demand, fueled by low interest rates, than there is supply of homes. So even if some of these properties, a lot of these properties come to the market that we've just talked about, it's going to take time for these things to trickle to the market. It's not going to happen overnight. And as they trickle to the market, chances are, they're going to get purchased, right? Almost every property that we're listing right now, friends in the business are listing, has multiple offers. I'm representing buyers on property. Almost every single one is a multiple offer property. And these buyers are just moving to the next property. The next one comes on the market. The same buyers that missed out on the last one, plus maybe some new buyers. So demand is there, and it's likely going to continue. I don't see that changing for the foreseeable future, especially if the vaccine does come out and it's effective. You're going to have, it's going to take time for that to actually take effect. But when it does take effect, you're going to have people gaining employment back again. You're going to have markets where entertainment and travel and all of that was suffering. That's going to come back. There's a lot of people dying to travel. There's a lot of people that want to be out and about, want to be in restaurants, want to spend money. So my guess is once this is under control, you're going to see the market come back pretty strongly, in fact. But that's not to say that there can't be bigger issues down the road from all of the stimulus. I do believe that there are effects of all of this that's going to need to be, it's got to be repaid at some point, or well, I don't necessarily know what's got to be repaid, but there's going to be effects from this. But I do believe that the housing market's going to remain strong for the foreseeable future. Now that doesn't mean you should go out and buy a house. Doesn't mean you should not sell your house because you think the market's going to be higher down the road. I'm just telling you what I think is going to happen based on the information that we have now. But I've been wrong before about many things in my life, and I could be wrong about this one. I'm just looking at the numbers. I'm trying not to read into the data to tell you what I think would happen if this happens and that happens and all of this happens. I'm just looking at the supply and demand right now, looking at those numbers, looking at the numbers of what's happening when people are exiting, and trying to give you, an educational look on it all. So I'm sure a lot of you are going to have questions, comments, what have you. I encourage you to put them in the comments below. And as I get more information on this, I'll continue to put it out, continue to update you. For now, I appreciate you taking the time to watch. We'll see you again soon. Have an awesome day. Bye-bye.